I want you to think about the last thing you bought. Not the big stuff. Not rent or groceries. I mean the everyday purchases. The small ones. The ones that felt completely normal. Because here is what nobody is talking about. It is not usually one big financial mistake that drains your account. It is 10 small ones, happening quietly, repeatedly, every single month. Purchases so normal looking that you never once questioned them. And by the time you realize what they were costing you, quietly, consistently, over months and years, the number is not small anymore. Today I am giving you the list. 10 purchases that look completely harmless and are slowly, quietly destroying your finances. Some of these are going to surprise you. Some of them are going to make you uncomfortable. And at least one of them is going to make you pull out your phone and check your bank statement. Good. That means it's working. I'm Josephine, and this channel is for first-gen earners who are done wondering where the money goes. Let's count these down. We start at number 10 with one of the most profitable things a retailer will ever sell you. The extended warranty. You know the moment. You are at the checkout, phone, laptop, fridge, washing machine, and the sales associate leans in and says, "Would you like to add the protection plan for just a few more dollars a month?" And it sounds so reasonable, so responsible even. But here is what they know that most of us don't. Retailers make more profit from extended warranties than from the products themselves, because the vast majority of products never need to be claimed on. And if something does go wrong within the first year, your manufacturer warranty covers it anyway. Add up every protection plan, warranty extension, and coverage add-on you have paid for in the last 5 years. I will wait. That number, whatever it is money that almost certainly went nowhere. Skip the extended warranty. Put that money somewhere it actually grows. Number 9. And this one is going to make some of you defensive. Brand name groceries. Before you click off, hear me out. I am not saying never buy your favorite cereal. I am saying, do you actually know what you are paying for when you choose the branded version? In many cases, especially for staples like flour, rice, canned goods, cleaning products, pain relievers, and basic pantry items, the store brand product is made in the same factory by the same manufacturer to almost identical specifications. The difference is the packaging and the marketing budget you are paying for every time you reach for the name. Studies show that switching just half of your weekly grocery shop to store brand alternatives saves the average household between 20 and 40% on their grocery bill. On a $200 weekly shop, that is $40 to $80 back in your pocket. Every single week. That is not a small number over a year. That is a holiday, or a month of investing, or 3 months of an emergency fund. From cereal. Purchase 8. Paying only the minimum on credit cards. Number 8 is not technically a purchase, but it is costing you more than almost anything else on this list. Paying only the minimum on your credit card every month. Here is what most people do not fully understand about minimum payments. They are designed by the credit card company, not to help you pay off your balance, but to keep you in debt as long as possible. Let me show you what I mean with real numbers. If you have a $2,000 balance on a card with a 20% interest rate, and you pay only the minimum each month, it will take you over 11 years to pay that off. 11 years. And by the time you are done, you will have paid back almost twice what you originally owed. The original purchase cost $2,000. Minimum payments turned it into nearly $4,000. That is the silent purchase nobody talks about. The interest, the time, the cost of the minimum. Pay more than the minimum. Every single month. Even if it is just $20 extra. That $20 saves you years. Purchase 7, lottery tickets and casual gambling. And I want to be clear, I am not here to lecture anyone, but I am going to give you the math. Because the math matters. The average person who buys lottery tickets spends around $5 a week. That is $20 a month, $240 a year. Now, your odds of winning a major lottery jackpot are roughly 1 in 300 million. You have a better chance of being struck by lightning. Twice. $240 a year invested in a basic index fund, starting at age 25. By retirement, that is over $60,000. The lottery is a tax on hope, and hope deserves a better investment than that. Purchase 6, the gym membership you are not using. I feel like we all know what is coming. The gym membership. January 1st, you sign up. You are committed. This is the year. February, you go 3 times a week. March once. April through December, you think about going. The membership still charges you every single month. $40, $50, $60 quietly leaving your account for a building you have not entered since spring. According to industry data, 67% of gym memberships go almost entirely unused. The gyms know this. Their entire business model depends on it. They would go out of business overnight if every member actually showed up. Here is your action. Pull up your bank statement right now and find the gym charge. When was the last time you actually went? If the honest answer is more than 6 weeks ago, cancel it today. You can always rejoin, but you cannot get back the months of membership fees you paid for nothing. Purchase 5. Fast fashion and trend-chasing clothing. This is one of the sneakiest ones on the list because it disguises itself as a deal. Fast fashion. I am talking about the $8 top, the $12 dress, the $15 pair of shoes that looked great in the photo. Each individual item feels like nothing, but they add up into something very real. The average person buys 68 pieces of clothing per year. 68. And wears each item an average of 7 times before it ends up in a bag for the charity shop. What feels like savings, cheap prices, is actually the most expensive way to dress yourself. Because you replace everything constantly. The cost per wear on a $15 top worn twice is $7.50 each time. The cost per wear on a quality $60 top worn 30 times is $2. The cheaper item costs more. Every time. Buy less. Buy better. Wear it more. Your wardrobe and your bank account will thank you. Number 4, and this is the one that hides in plain sight. Convenience fees, delivery charges, service fees, processing fees. Think about how many times a week you pay a small extra charge for convenience. The delivery fee on your food order, the service fee on your event ticket, the processing fee at the ATM that is not your bank's, the surge pricing on your ride, the express shipping you chose because you wanted it faster. Individually, these feel tiny. $1.50 here, $3 there, but the average person pays over $300 a year in convenience fees alone. $300 for the privilege of not wanting to wait or plan ahead. I am not saying never use delivery. I use it, but I am asking you to make it a conscious choice, not a reflex. Plan your grocery shop once a week. Use your bank's ATM. Choose standard shipping when you do not actually need it today. The fee you avoid is money that stays in your account. Quietly. Every week. Purchase 3. Upgrading your phone, car, or tech before you need to. This one is going to make some of you squirm. Upgrading your phone, your car, or your tech before you actually need to. The average person upgrades their smartphone every 2 to 3 years. Not because their current phone stopped working. Because the new one came out, and the marketing made it feel necessary. The average new phone costs over $800. If you upgrade every 2 years, that is $400 per year just on phone upgrades. Over a working lifetime of 40 years, even with inflation, we are talking about tens of thousands of dollars on phones that worked fine. And cars are the same story, only louder. A new car loses between 15 and 25% of its value the moment you drive it off the forecourt. Buying a car that is 2 to 3 years old means someone else already took that depreciation hit. You get the same vehicle for a fraction of the loss. The question is not, can I afford the upgrade? The question is, does my current one still work? If yes, keep it and invest the difference. Number 2. And before I say anything, I understand. You are tired. You work long hours. You do not always have the energy to cook. That is real. And it is valid. But I want to show you something. The average meal cooked at home costs between $2 and $4 per person. The average meal ordered in costs between $15 and $25 before the delivery fee, the service fee, and the tip. If you order in or eat out just 5 times a week, which is not a lot for most people in this generation, you are spending somewhere between $300 and $500 a month on food alone. Cook those same 5 meals at home, $40 to $80. The gap between those two numbers, $200, $300, $400 a month, is not a small lifestyle choice. It is the single biggest invisible expense in most of our budgets. I am not saying never order food. I order food. I am saying make it a treat, not a default. Plan 3 meals a week at home. Start there. The savings will show up in your account within the first month. Purchase 1. Lifestyle inflation. spending more every time you earn more. And the number one purchase quietly destroying your finances. This one is different from everything else on this list. Because it is not one purchase. It is a pattern. Lifestyle inflation. Here is what it looks like. You get a raise, so you move into a better apartment. You get a promotion, so you buy a newer car. Your income goes up, so your lifestyle goes up with it. And at the end of every month, no matter how much more you are earning than you were 3 years ago, there is still nothing left over. Because every time your income grew, your spending grew to match it. Dollar for dollar, pound for pound, and you are essentially running in place on a faster treadmill. This is the trap that catches high earners, the people who make 6 figures and still live paycheck to paycheck. The reason someone can earn more than their parents ever dreamed of and still have nothing to show for it. The antidote is one of the most powerful financial habits you can build. When your income goes up, let your savings go up first. Before the new apartment, before the car upgrade, before the wardrobe refresh. If you get a $300 raise, automate $200 of it directly into savings or investments before you can touch it. Live on the extra $100 if you want. Treat yourself a little. You earned it. But protect the majority before lifestyle creep has a chance to swallow it whole. The goal is not to earn more. The goal is to keep more of what you earn. And lifestyle inflation is the single biggest thing standing between most people and actual wealth. So there they are. 10 purchases quietly destroying your finances. Extended warranties, brand name groceries, minimum payments, lottery tickets, unused gym memberships, fast fashion, convenience fees, upgrading too soon, eating out as a default, and the biggest one of all, lifestyle inflation. Now here's what I want you to do. Pick one, just one item from this list, the one that hit hardest, the one that made you wince a little. That is your one thing to work on this month. Not all 10. 1. Because sustainable financial change does not come from doing everything at once. It comes from doing one thing, consistently, until it becomes normal, and then doing the next one. Drop your one thing in the comments. I'll read every single one, and I want to know what you are working on. And if this video made you think of someone who needs to hear it, share it with them. Because the best thing we can do for each other is pass the information on. Subscribe for a new video every week, just for us. I will see you in the next one.